and welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been in business since 1970, delivering investment ideas, research, stock picks, and all kinds of other goodies for more than half a century. I'm Chris Preston, Chief Analyst of Cabot Stock of the Week and Editor-in-Chief.
And I'm Brad Simmerman, Web Editor and Chief Analyst of Cabot Wealth Daily. Today on the podcast, we are going to talk about latest inflation figures, whether there's something to be concerned about, the rise in oil prices and the impact that's going to have on the broader economy, and the unfortunate injury situation with Aaron Rodgers, who threw two passes and then went out for the season in his debut for the Jets, and what the closest investment parallels are.
So that should be a fun discussion. We're also going to talk about the IPO market picking up, which is also a positive thing. ARM went public a couple of days ago. There's some more big names in the pipeline. So we're going to get into that and what it means for the market as a whole and just IPO investing in general. But first, as always, we lead off with Defend the Take, which today, Brad, is you. And you have a take, everyone's favorite subject. It's on everyone's favorite subject, COVID. Remember that? Your take is that a worsening COVID fall is good news for the most heavily shorted stock on the market right now. You have 90 seconds. What do you got?
Okay, so right now, per a screener on MarketWatch, the highest percentage of float of shares that are publicly traded outstanding short is Novavax. It's 46%, 45.77 as of this moment. Percent of its short is, or percent of its float is short right now. The issue that I primarily have on, Novavax, if you look at a chart of it, it ran up with the arrival of COVID after essentially just slogging in a downtrend for most of its existence, because it's a biotech research company that just loses money until it has a ton of money and then, sells to somebody else or gets a licensing deal or whatever and actually starts turning profitable. The issue that I've got with it, and the reason that I would be very wary of trying to pile into something like a short position in Novavax, is that the outcomes that they can face are totally independent of the investing environment. It's not just about a company sort of doing what it does best and doing it well and executing and turning a profit. The latest rounds of COVID updated vaccines are going through CDC and FDA approval right now. Pfizer and Moderna's mRNA vaccines both got approved. Novavax has a protein-based vaccine that's not yet approved. But if you are betting on Novavax losing money from here, share price declining, it's actually up over the last week or so. If you're betting on that, you're essentially betting on random mutations, which is not good business sense or not good investing sense.
Okay, yeah, you're close to hitting the post there. Just looking at Novavax, literally the chart from 10,000 foot view, 5-year chart. It peaked at in February 2021 at $290 a share. It is currently trading at just under $8 a share. Seems like there's not a whole lot of not a whole lot of downside at this point. If this is the most heavily shorted stock, it seems like you want to be on the other side of that trade, especially given what you're talking about with the vaccine and COVID cases rising again. Seems like a low risk proposition if you want to be on the buy side.
Their leadership has sort of positioned it as, hey, there's a chance that we go out of business because nobody is inclined to get a booster, or we can't generate any more profit creating drugs. And obviously vaccine resistance is an issue, efficacy is an issue, but if you're a short in Novavax right now, the worst case scenario is that there's a mutation that comes out that their protein-based vaccine is highly effective against, and the mRNA vaccines are not.
Yeah.
Something like that, which again, totally random mutation could cause that. you could see a short position. You could be short at 7 and wake up and see it at 70. So
Right.
if you want to try and short NVAX, look for some put options or something like that where you can manage your risk. I cannot justify shorting NVAX right now, which means it will probably go bankrupt tomorrow. Because
Well, yeah, yeah. I mean, it just seems like a stay away. I'm looking at, so it's trading at 1.5 times earnings, and yet the sales growth, current upcoming quarter, current quarter, yet to be reported, 69% loss projected, and for the year minus 31%, next year minus 5%.
and
Uh, yeah,
next quarter for them, their next quarter earnings are gonna look bad. They sort of front loaded this most recent quarter's earnings with deliverable or with orders that are getting delivered or fulfilled or closed out of their balance sheet next quarter. So next quarter is going to be bad for them, but there's just not a lot of juice left to squeeze out of this.
yeah,
If you're messing with it, it's gambling. It's not
yeah.
you can't
Seems
really
like a
make
stay
a
away. You stay away, not a buy or a sell.
or if you want to take a chance on it, maybe a small speculative option play. But
Yeah, yeah,
that's one to stay away if you're a bear and if you're looking to short it at all.
yeah. Okay, let's get under our big three. Number one, inflation. New CPI number came in this week. Little hotter than expected. Was it
7.
3.7% was the headline number year over year. 3.6% was expected, so not a big difference. Month over month was it 0.6%?
Yeah,
It was a
and
little
then
higher than expected. But a lot of it is oil, which seems like people knew that going in and understand that after the number came out, with oil prices at their highest point all year, $90 a barrel now and climbing. You strip that out, it's still in the same sort of generally slowly downtrending trajectory, which is why it seems the market didn't react much. There was no sell-off after the number came in. Remember, beginning of this year, one of the things that kept setting the market, backpedaling every time it built up some momentum was if inflation number came in, if it did come in like 0.1% higher than projected, that would be a 2% sell-off that day, maybe even for the next few days. That didn't happen this time, so it seemed like a big shrug of the shoulders to the inflation number.
yeah, if you strip out the energy prices, the core PCE was showed a 3.1%, I believe, was the annual number that
Yep.
came in. I think this is a testament to the Fed being pretty good at signaling what they're going to do. They're saying higher for longer. Inflation is coming down visibly. This time last year we were close to 9% inflation.
Yeah.
So that's a 66% or so reduction in the overall rate of inflation. The market is now pricing in a 97% chance that the Fed holds rates steady in the meeting later this month. Yeah, I know there's some speculation about higher rates maybe at the end of the year, which I guess we could see if oil prices stay elevated and start sort of trickling through to other sectors, which is something that we'll talk about shortly. But it's not a surprise. It's not been a surprise. It's been sort of the obvious play for the most of the back half of this year.
Yeah. And
So
an inflation number wasn't a surprise. As long as it continues to not be a surprise, then I don't think the Fed will surprise us with anything more than, like you said, they could raise rates one more time, 25 basis points. I think if that happens, I don't think that's going to spark a sell-off either. I think anything more than that would, and anything more than that would probably be necessitated only if inflation, inflation isn't higher just because of oil prices, like you said.
what I'm going to be listening for or looking for with the next Fed meeting is whether they start changing their tone around what inflationary indicators they're looking at. The PPI, the producer price index, came in hotter than expected. If the Fed comes out and all they do is cite core PCE and cite volatile energy prices, I think it's still an ongoing sort of green flag. But if they start pointing at other segments of the economy or other pricing inputs as being problematic, so something that hadn't been explicitly on their radar, that's when my antenna go up, and I'm more looking for rate hikes at the end of this year or even into next year. But if they come out and they're hitting the same talking points, I don't think it's something that we need to sweat yet.
Right. So, well, speaking of things we need to maybe sweat about, we talked about oil. Oil, prices are way up, over $90 a barrel now. The Saudis have cut production, which has lent a hand to the rise in prices. It's obvious affecting inflation, but there's also sectors that are feeling the brunt of it, or at least in terms of the market, are feeling the brunt of it, especially airlines, cruises. I think you mentioned plastic inputs before we went, like Dow Chemical or potential sort of high oil price victims. But these are short to intermediate term problems. Given how much, so what is it? The Jets ETF, which tracks airlines, is down, I think 9%. Some of the cruises are down a bit.
In the last month.
You mentioned, Brad, a couple months ago, I think one of your defend the takes was travel stocks will outperform. Did you say outperform NVIDIA or outperform AI the rest of the year? That was looking good through the end of the summer with all the revenge travel that we talked about. Now it's coming back. It's pulling back with high oil prices. Where do you think it goes from here?
So, I think it's going to be. I think it's going to be very, very specific to each company. I think there's like structural travel issues that are sort of hitting now that are having more impact than oil prices. Oil prices in the short term are they cut into airline operators' profits, but you've got bigger structural stuff like negotiating with pilots. Software issues have been a problem. I still like travel, especially sort of heading into the end of the year, holiday season. The industry, Royal Caribbean was a name that I think I had mentioned that Mike Santolo wrote about recently for a Cabot Wealth Daily as a stock that looks good and is consolidating and sort of building a launching pad, as he would put it. And he cited management commentary that they're able to pass through higher prices and stay at and above maximum capacity for travel or for cruise bookings. So I still like travel heading into the end of the year. If we get that fall COVID wave, that would be sort of good news for Novavax. That's going to be terrible news for travel stocks if people start paying attention again. I don't necessarily know that they will. And then for airlines, what's that? Oh,
I don't think so. Short of another
Omicron or
Omicron. That's the one I'm thinking of. I've like blocked so much of it out at this point. I'm sure a lot of us have, but short of another Omicron occurrence, I think people are done with COVID.
Yeah. So, all right. So then maybe that's not as big of an overhang. I mean, the situation is always subject to change, but I do still like travel. I do still think that people are prioritizing getting out, getting around. I think, this year's holiday travel season will probably be really, really busy. And I could see as part of that, people prioritizing going to see family, spending more on travel, spending more on accommodations, and maybe spending less on gifts. Everybody sort of, we've all sort of accumulated all of our stuff for the most part, or at least that's sort of how the spend is looking right now. So I still see a case for that. I mean, if you told me right now, buy Jets or buy NVIDIA, I'm buying Jets.
Yeah, no. So looking at the Jets chart, down almost 20%, 18% since its highs in early or mid July. It's trading at 18 now. So right about the same place it was in March, in mid-March. And yeah, I think for the reasons we mentioned, I don't think COVID's stopping people from traveling much this winter. And I think the travel boom that was in place in the summer, I don't think is going to come to a screeching halt just because oil prices are a little higher, which, maybe, you're driving somewhere for the holidays. I don't think you're going to not go because you have to pay a little more at the pump. And similarly, even if airlines raise their prices even more as a result of higher oil prices, I don't think people are going to not go, given how hot travel was this summer and has been for like the last year. So I think this is a good time to buy travel stocks, airlines, cruises, etc. And I agree with you that I'd rather buy that than Nvidia right now.
So American Airlines is trading at 3.5 times trailing earnings right now. The airlines did come out in the last couple of days and cut profit guidance going forward. But here's the thing: if you care about valuations and you see a company like American trading at 3.5 times earnings, how bad does guidance have to be to actually scare you away, right? Like if valuation matters and you see the company trading at that cheap of a price, it can't, I mean, yeah, it could trade for less than 1 times earnings hypothetically, but I don't see it getting that low. I think that this is probably with the weakness in the guidance going forward with higher oil prices. I think this is probably a good time to accumulate. So look at it maybe as more of a buying opportunity than as a long-term, oil's not going to be a long-term headwind for the airlines for long.
Yeah, agreed. So you mentioned long-term. Let's go to something that was very short-term. I'm sure for many of you, maybe some of you are Jets fans, and for you have my sympathies if that's the case. Aaron Rodgers made his much anticipated debut as quarterback of the Jets after many years with the Packers this Monday night against my Bills. Bills still figured out a way to lose somehow, even after Aaron Rodgers, as you mentioned, Brad, went down with a torn Achilles in the first series. I think the 4th play from scrimmage and is out for the whole year. What we were thinking, that got us thinking, what are the investment world parallels to this? Something with so much hype. That hype delivered the highest ratings for Monday Night Football, I think, in 20 years, something like that, or it's just like 2000. So something with this much hype fizzling almost instantly. A couple examples that came to my mind, and I'll let you. I'm sure you have some too, Brad. Zoom video, it wasn't as instant. Obviously, that was a big thing during COVID. Had a huge run up. It was, legitimately, and we had, analysts at our company recommending it, with good reason. It went, everyone was on Zoom. We're on Zoom literally right now. But it's not the craze that it was back then when that was the only way people could really communicate. It went from beginning of 2020, right around $73 a share, or just under $73 a share, to by October, $559 a share. Now it's back to 71. It's flat since the beginning of 2020. So I guess that was a little bit longer trajectory. Peloton, somewhat similar. Luckin Coffee is one that comes to mind for me. Now that's actually since come back, but that was, if you recall, that was all the rage. It's basically China's version of Starbucks. I mean, they have Starbucks too, but rivaling Starbucks in China. China has become more of a coffee drinking nation than it used to be. And that was, again, we had analysts here recommending it, and then it fizzled based on faulty or false reporting of numbers, and I think egregiously so, and various other reasons. What are some examples you have that are Aaron Rodgers to the Jets parallels?
So one thing that I did is I avoided the sort of obvious pump and dump stocks. There was a Lithium Exploration Group of America, I believe was the company name, a few years back that went from 10 cents a share to $7 a share, and then immediately back down to $1 within like a week or two. And that one, the company was one rented office suite in an office park in Scottsdale, and they supposedly were this like lithium exploration company. So I avoided some of those. The first one that came to mind was VinFast, right? That was that thinly traded Vietnamese EV maker that ran up over 80 a share and now is trading at like 17. It's below where it IPO'd a month ago. Rivian is another one. The reason that I like Rivian as sort of my best parallel is because it essentially top ticked the market. It IPO'd on November 12th of 2021, which was effectively the first day of the bear market.
Right. At least in the NASDAQ, yeah.
I might be wrong on that IPO date, but that's the first sort of week that it started trading, is that first or second week in November. It's down 81% since then. It has done nothing. Let's see, last quarter they lost 1.2 billion, which was a 30% improvement. Part of the reason I like Rivian as a parallel is I'm not a big Rodgers fan. So it's something that got
you always felt that Rivian was a bit overrated.
Yeah, I would say Rivian
compared
has always
to
been a bit,
like Tesla being the Tom Brady. There's always been this slander, like, oh, Rodgers better quarterback than Brady. Give me a break. Go ahead.
Yeah, no, you're exactly right though. The premise behind Rodgers getting 75 million guaranteed this year is that he's a more talented quarterback than I think he actually is. Cardinals fan
at age 40 or whatever,
40,
almost 40. Yeah.
I'm not saying he's a bad quarterback. He would be a significant upgrade for the Cardinals right now, who I don't even remember the name of their starting quarterback. It's somebody they just traded for. As far as I'm concerned, they're not fielding a team this season and won't be until next season. So I'm at arm's length with it. Another one that I think Rivian's my best pitch.
Yeah.
Chegg was another one. Do you remember that?
Oh yeah, that was another one we recommended. Yep.
That
online educational.
Yeah, that for-profit investing theme that sort of showed up in the late 2010s really accelerated into the pandemic because everything was being disrupted. In the last year, Chegg is down 57%. In the last 5 years, it's down 68.5%. From its high in February of 2021, it's down 91%. That one I don't think is a fair analogy for Rodgers because that had nothing there.
The hype of Zoom video. The key is the hype. Zoom, yes. Zoom, Peloton. Maybe Vin, or I guess Rivian for sure.
Yeah.
Hype. Yeah.
So I think I'm going to stick with Rivian on that one, and it's you feel bad for Rodgers, like him or not. He's putting in the work. He's been doing it a long time, and an injury that's always bad luck.
I would feel bad for Jets fans if they didn't go on and beat my Bills after that, but it's still a pretty tough break. Looking at Zach Wilson the rest of the year. Okay, let's move on to our theme for the week. Just a second before we do that, I just want to remind people you can email us at streetcheck@cabotwealth.com if you have any questions, comments, complaints, anything. Feel free to send us an email. And then, as always, there's a free podcast. We've been coming through for you every week since April or May. So least you can do is just give us a like, hit that like button, subscribe, a nice 5-star
review.
Review, that would be helpful too. So please do us a favor, and spread the word. That would be helpful too. Okay, so our theme for the week, we just talked a little bit about. You mentioned VinFast IPOs. IPO market has picked up noticeably in the last few months, and actually, there's some big names coming out now. ARM, notably this week, was a big one. There's Databricks, which is an AI company that was just valued at $43 billion, $500 million in its pre-IPO round of funding, thanks in part to NVIDIA. It's already the 8th most valuable private company in the world, even before is yet to go public. Instacart is in the pipeline. And there's more. Basically, the IPO market is making more noise than it has in 2 years. Now,
Yep.
it's nowhere near where it was. I mean, it was a record in 2021. Over 1,000 companies came public on U.S. exchanges, which was more than double, I think, the
Yes.
record. That should have been a pretty good clue right there that we were at the top of the bull market. But it's good to see now that that IPO market is coming back.
Not only the IPO market being frothy in 2021, but the fact that SPACs became so big,
yes,
where it was like, hey, we want to do an IPO so badly, but we can't show that we're going to be profitable in the next 5 years, or we don't have, great projections going forward. Let's SPAC it. We'll just SPAC it. It's a different form of an IPO. So that was definitely, in hindsight, a tell of that market frothiness. ARM's IPO is the biggest IPO since Rivian, which was October of 21. As you said, over 1,000 IPOs in 2021. Last year it was like 100.
ARM might be the new Rodgers.
40.
Yeah.
I'm interested in ARM because their customers were so interested in becoming shareholders.
Yeah.
So a lot of the buyers of ARM's chips were interested in taking a stake in the company as a means of helping to secure their own chip supplies. So there is still some precarity in the semiconductor manufacturing market supply chains, right?
Yeah.
Like you've got Taiwan Semi working on a plant that's, I don't know, 10 miles from my house, give or take. You've got obviously concerns with exports to China still. One thing that I wanted to do is to look a little bit closer at what the IPO market looks like for retail investors. Because, any of us that read the financial media or follow it will see these big names coming public and be like, all right, well, yeah, I'd love to love to get a piece of ARM, but when it comes public, or Instacart, Birkenstock announced that they're filing. I don't know how much demand there is for Birkenstock stock. I've never owned a pair of their sandals.
Is this 2003 instead of 2023 Birkenstock going public? I'm shocked it wasn't. Yeah, I almost was going to say that, but yeah, that felt too mean. It's good that these companies is a good sign that these companies are feeling comfortable to go public now. That tells you a lot about this market, and you combine it a hot or hot-ish IPO market with the VIX at lowest levels in at least 2 years, more than that.
It's close to, it was like 11 or 12.
2019. Is this since 2019? It's down in like the 13 range. And retail sector, keeps exceeding expectations, and there's a lot to like about where we are in the market now. It's been a pretty boring, I think you called it off mic, boring market in the last month, and that's true. First half of August wasn't boring. It was just somewhat concerning pullback. Well, now that's settled into just sort of a holding pattern really in the last month. And considering we're in the market's weakest month historically or seasonally of September, the fact that things are just sort of holding is almost like a victory. And it seems like the market is collectively holding its breath for the next big push in this bull market. Again, as I've mentioned several times on here, new bull markets rarely just up and fizzle in like the first year or even couple years. So I think another big leg is coming, and I think the IPO market picking up is one of the first, a really good sign of that. I think it's the first indicator that things are going to pick back up. And ARM up 25% in its first day. Who knows what'll happen in the next few weeks, but that shows that the appetite is there.
Yeah, and I want to commend the IPO sponsors for ARM for doing like a really, really good job of it. They priced it $51 a share. Word is that ARM Holdings had been approached about maybe raising that target price, maybe as high as 57 a share, and they had an indication of enough buyer interest at that price, but their management effectively said, nope, we're not going to risk a successful IPO over a few $1,000,000. We're going to go live at 51. As you said, stock, it's at 65 now. It traded up. For most of the day, it was up 15 to 18%. Now, there's two ways to look at that. On one hand, if the market was there to support a 15% price increase, the IPO sponsors could have if the issuing bank could have asked for more money, right? Like hypothetically, that means they underpriced the IPO by 15%. But it's a far better outcome than failing to drum up enough interest and having to sell shares at, say, 42. Right. If you're sort of over promising and then the interest isn't there and you price below your anticipated IPO, that immediately kills all market interest as well. So there are sort of two ways to fail on an IPO. This one really did sort of hit the sweet spot. The unfortunate thing with most of these hyped IPOs is that if you're the average investor and you're excited about potentially getting into a stock, odds are that there's going to be a lot of institutional money that is equally interested in getting into a stock, which unfortunately means you're fighting with the big boys to try and get an allocation. And most brokerage houses have very little stock of the highly sought after IPOs, have very little shares that they can then allocate to their retail investors. Most of it goes to their large money investors, the private client groups, the people that are in portfolio products, things like that. So if you're very, very interested in an IPO, generally speaking, you get the short end of a stick because the only way for you to buy it is at market prices once it starts trading. And those are often very, very elevated. ARM is trading at 120 times their last year's earnings right now.
Yeah, I mean, it's a higher valuation than NVIDIA. So yeah, it's a high valuation.
Yeah, I think the best case if you're an early investor that got shares right after the IPO is that you get that it just sort of is trading sideways for a while. Whatever big run it had in it as a result of the IPO, it got when it started trading the next day.
I mean, for me, there's a difference between the IPO market and investing in IPOs themselves. IPOs for me are stayaways, and the more hyped, the more you should stay away. Look at Facebook. Its first year, it took a whole year for it to get back to its IPO price, and since then it's been a great investment.
I got a better Aaron Rodgers IPO pick for you. Oatly. Do you remember Oatly?
No.
Oatly was the oat milk manufacturer that had like semi-viral ad. The ads were like fun and quirky. There's sort of a Ben and Jerry's y. So they were the immediate beneficiaries of the almond milk thing, pivoting to oats because it's so water inefficient. They started trading in May of 2021 at 22.46 a share, closed the first day. They got as high as 28 in June of 2021, and they are down 96% since then. Okay. So with the Rodgers thing, there's a history. With this one, it's more like Josh Rosen, the UCLA quarterback that got drafted by the Cardinals, was the worst quarterback in football.
And Rosen are two names most people will forget.
Yes, but yeah. So Oatly, that's one of those things where it's like the hype is there, but they're just not able to deliver it all.
Empty calories, literally, in Oatly's case.
They lost 86 million last quarter. Their market cap is 613 right now. They're trading at $1.05 a share.
So I mean, this is why I think I never recommend IPOs to anyone. I think Tyler London, who's our small cap investor, who literally runs an advisory called Cabot Early Opportunities. So he's looking for early stage investment opportunities. He even says give stocks 3 months. to be public. There's always the hype, and a lot of times overhype. The bigger the name, the more the hype. And there's usually, euphoria for the first few days, maybe even a few weeks, and then it comes crashing back down. And then after that, maybe after I think part of the reason he says 3-4 months is you wait for those first earnings to come out. You start to get a real clear picture of what the company actually looks like. And so then it's just the reality phase. The hype is gone, and you can just invest in the stock, and you're not investing in pure hype of an IPO. So while it's good that all these companies are companies whose names are coming public, that's a good sign for the market that appetite is there for this kind of thing. I wouldn't invest in any of them, not in the first 3 months or so.
So if we look at there's an IPO ETF, it's Renaissance IPO ETF,
Yep.
the ticker's IPO. In January of 2020, they were trading around $32.80 a share. They're currently trading at $32.90 a share. Their top holdings are Airbnb, Snowflake, Palantir, DoorDash, Li Auto, Coupang, which I vaguely remember. I don't remember what they do though.
Yeah.
Coinbase, Roblox, and Rivian. And that Renaissance IPO performed really, really well from COVID lows through October of 2021, and then into November, right? So the froth was great for it, but the real investing environment, like generating operating profits going forward, has really been unkind to that fund. And I don't see that changing, but I do agree with you 100% that the fact that companies are now willing to essentially wager their market cap in the open market by doing an IPO, I do think that is a vote of confidence for the broader economy and for the broad market as a whole. There is investor interest. We've been talking about sort of that rotating bull market. The summer performance of travel stocks sort of shows that. The flat performance of AI since end of July sort of shows that similar rotation. So I would be less interested in maybe getting in on those IPOs, but I do like seeing it. I do like seeing that that's taking place right now.
Yeah, it's good. Birkenstock. It's a green light for starter jackets to come public too. That's still around. Samba. That's Samba. That was the shoe. The white stripes, black shoe, white stripes.
Starter jackets. I remember. Samba. I do not.
Okay.
I was never a big shoe guy until my older years.
Reebok,
when I started.
Time for Reebok to come public. Maybe it already is, but it's probably a terrible stock. So yeah, I mean, I think even though the market basically didn't move this week, I think there's been a lot of positive signs between it not cratering after inflation came in slightly hotter than expected, between retail sales coming in slightly better than expected again, and then, as we talked about, the IPO market picking up and ARM having, pretty successful debut. I think there's a lot of positive signs out there, even if it's not showing up in the, the broad indexes themselves, the benchmark index themselves, the S&P, NASDAQ. That's still in a range. It's still, if you look at that, you look at most stocks, it's still a pretty boring market out there. But I think that will change before year's end. I think there's reading the tea leaves, including the IPO market. I think we're in for a much better fourth quarter than the last 2 months have been.
Let me pitch something to you. I just had this thought. All right, so we've got Instacart's IPO coming up. They're the next most anticipated, and certainly a name that investors are going to be more familiar with than ARM, right? ARM had talked about going public 2 years ago. They've been owned by SoftBank for a number of years. I think they were valued closer to $70 billion during the 2021 market rally. So that's a name that not a ton of people know. Instacart is probably
everyone knows. Everyone who lived through the pandemic knows it, in the US at least.
So why not just go buy Uber, right? Instead of, if you believe that Instacart IPO is going to go gangbusters because grocery delivery is the future, buy Uber because Uber also does food and grocery delivery. and they've got a much longer track record of public results.
Yeah.
Right. So if
People
you're
delivery.
Yeah, people delivery. If you find yourself really interested in a pending IPO, look at some sector peers, because if the sector itself is strong, it's going to do well for the peers, barring some sort of systemic problem with the company itself, right? Like if Uber decides that they don't want an app anymore, right? Like that's catastrophic results for their business. That's not sector related at all. But if you find yourself attracted to a hot IPO, look for some of the peers that will benefit from sector strength and would potentially benefit from outperformance of the IPO. If Instacart comes out and it's valued at 38 times earnings or whatever it ends up being, and Uber is trading at 20 times earnings, there's room for Uber to catch up to get closer to its peers on valuation. So that would be my takeaway: is avoid the hot IPOs. But if you really like the sector, look for other names that are already public and even newly public. It's not like Uber's been publicly traded for that long. It's only been a few years. So,
right. Yeah, that's good advice. Yeah. Yeah, IPOs, avoid IPO market. Good sign. Thanks to everyone for joining us this week for the latest episode of Street Check. We'll be back next Friday. And again, hit the like button, subscribe, 5-star rating.
Email,
streetcheck@cabotwealth.com. Any final words, Brad, before we sign off?
That's all for me, folks.
Oatly. See you next week.